Bringing Herb Greenberg, editor of Herb Greenberg and On the Street on Substack. I think I messed that up, Herb, or they did. Anyway, welcome. Okay. So where do you want to start? I mean, which is most consequential or telling?
Well, I think the one that I find interesting, because I've been writing about it since May of 2023, is Topgolf, because it actually could be a trend that's fascinating in the sense that it is indicating deals that shouldn't have been done in the first place in those heady days of 2021 that are now unwinding and coming undone. I mean, I red flagged this company in May of 2023 in my red flag alerts, which is part of my Substack, and the stock has lost half its value since then because, look, it was heavy in debt. You know, the glory days didn't go. It was a poorly conceived deal, and now they're going to break it apart. So I think you have to look to see if we're going to see more situations like that, which is, you know, very different than, say, a Verizon and Frontier, where, you know, Frontier had an activist investor in there that was looking for them to do something over time. Verizon's looking, you know, to build out bandwidth and fiber. So, you know, that's a specific situation. And then, of course, you have the political aspect of something like U.S. Steel, which is just a one-off in that regard, but could be very interesting because as we go forward from, you know, an election standpoint, right? You know, what really matters? The FTC matters and antitrust matters. And if you wanted to wonder whether this market is going to become a bigger deal market, Kelly, I would suspect that that is probably the one thing people will be watching, along with interest rates, which obviously, if they went lower, would bring in private equity, which have been sort of stuck in the mud.
Right, that's true. That's been a kind of a key catalyst on the sidelines. I think the regulatory environment has been a buzzkill in many of these deals. So let's dwell on my favorite of these, the Topgolf Callaway situation. What do we take from this? What do we learn from this, Herb?
Well, I think you learned that a company that, you know, in the go-go days of I come back to 2021, where people were, you know, rates were low, lots of debt was spent on the steel. It literally did not bring this company into, I mean, it was just, I never understood the deal. When I wrote about it and I red flagged it, you saw high debt, low free cash flow, net income really falling off. And the company started to, if you go back and you actually start watching, the company was actually starting to come up with what I call made up metrics that it was telling the street to look at. And as you saw these things happen, it was under increasingly a lot of pressure. And as the stock continued to fall, they had no choice but to, you know, try to now split themselves apart. Obviously, there's no buyer, so they split themselves apart. So I think you find out that these deals that shouldn't have been done are now coming under fire, especially in a market like this, which is, I would call a much more jittery market.
Herb, I mean, maybe your focus on this is because you live in the right part of the country to focus on this. They're not that far from where you are residing right now.
No, they aren't. No, they are just up the road.
Okay, so here's my question. My question is, this is now going to become more of a company pure play for golf equipment and apparel, and then one that's going to be focused on this golf entertainment side of things. How much do you think that Acushnet's outperformance during the span of 2021 till now played into the decision? Because then people say, hey, you know, we can value a pure play golf equipment and apparel business more readily than we can a conglomerate like Topgolf Callaway.
I think that's key to it because, you know, you obfuscated what the real business was. I mean, Topgolf, you talk to people about something like a Topgolf, they'll say, oh, it's a great experience. I love going there. It's just very expensive. And again, Topgolf was a post-COVID play. And these are, you know, just like bowling or anything else. These were things that did exceedingly well at that point of time. But it's not inexpensive to use and go to, and it's something that did really well during the pandemic. And, you know, again, you know, they're building an enormous facility here in San Diego. So it's not going away, but I think you have to separate the two of those. Otherwise, you're not going to get the pure play. And if golf is, you know, look, I've followed Callaway for, I think, since it ever was public, and it was a controversial name all the way, you know, from Big Bertha on. It was an up and down type name. And this, you know, from my perspective, this deal, I just never understood this deal. But by the way, and I do know people who bought the stock and loved the stock, some really smart people who loved it as it was with Topgolf. But I think you need to separate the two.